Kenneth Akintewe, I don't know if I've got that pronunciation right. More than likely, Kenneth, I've got that wrong. He's the head of Asian Sovereign Debt at Abrdn Investments. Kenneth, hi. Thanks a ton for joining in. Kenneth, Neeraj and me are sitting in the studios feeling very excited and proud, actually, as India does finally make it to the JPM bond index. This is also significant because up until very recently, our ratings was just a notch above junk. And especially when India's got a strong growth story, it's got a solid reading in terms of the way the currency has been behaving. Performance of Indian paper has been far better than most or all emerging markets in the recent past. And inflation is not really a concern, and policy continuity remains. So keeping all that in perspective, what are your thoughts? How big a deal is this?
Good morning. And yes, you should indeed be feeling very proud. I've been covering India for 20 years, but 20 years ago, it was almost impossible as a foreign investor to invest in the India bond market. It's been one of the most challenging and, dare I say, frustrating markets historically to invest in. So that just tells you how far India has come. Both in terms of its economy, but with wide-ranging, sweeping reforms, its capital markets as well. It is important for India. It is indicative of the many, many reforms that have happened across the board. But we mustn't lose perspective that this is even more important for foreign investors because the world that India is operating in is a very challenging universe, and none more so than for emerging market investors. You noted the performance of some of these markets. Local currency emerging markets are down 4% this year. Global bond markets haven't performed very well, but India is actually, up roughly about 4% year to date, maybe even slightly more. So when you think about the volatility in emerging markets, we've gone through volatile politics in many, many EM economies like Mexico and so on. When you put India into that basket of risk, this is going to significantly benefit foreign investors. As soon as you include Indian bonds into these portfolios, the volatility of those portfolios drop, and most likely the risk return profile of those portfolios improves significantly. So the sooner India can get to its maximum 10% weight in these indices, and investors can be encouraged to increase their weighting in the market, the more they're going to benefit from the very, very favorable risk characteristics that Indian bonds give investors.
Can completely take your point, right? I mean, I think there was frustration because there's only limited ways in which you could go out and buy Indian paper. And up until now, it was always a hedge or an arbitrage instrument. It was never really long-term sticky money that came away. But how does this change the dynamic for active investors as well, right? So you have passive funds that are going to come in through the JPM. Will this also nudge active managers who've been trying to front load? And they have. We've seen about $10.4 billion of money come in even ahead of this inclusion today. What does it mean in terms of total inflows that we can expect? And do you feel like this could be a trigger where cost of funding could go down, not just for government paper or government borrowing, but even India Inc. that borrows outside?
I mean, investors, to be honest, already have had active overweights to India. If you look at most emerging market local currency portfolios, they have actually had some exposure to the India market. Now we can debate how they took that exposure. Maybe not all of it was in the domestic bond market, structured products, some of the alternative investment routes. But more and more of those investors are likely to now invest into the domestic market as their main source of access. And if you look at the relative performance between Indian bonds and some of the other EM or even global bond markets, it would strongly encourage these investors to have an overweight position. So obviously over time, there'll be new investors coming into this market. Their main priority, first of all, will be to ensure that they have at least an index weight. So you're not sitting underweight the India market, because that could drive underperformance of your portfolio. So a relatively passive position, first of all, but as the familiarity of the market, both in terms of the drivers of performance, how to think about how RBI conducts policy, inflation outlook, as these investors become more and more familiar with the India story, they will become more and more comfortable with trading the market. So you'll begin to see more active management of the market. Now, of course, that comes with in the more medium to long term, a slight risk, because as investors become more active, then the volatility may pick up slightly and maybe the correlation to other markets may pick up slightly as well. But I think we're a very, very long way away from that being a concern. You're asking about the amount of flows to come into the market. So the JPMorgan bond index, GBI-EM index, there's roughly around $300 billion of global capital that track that index, and India will have a 10% weight in the index. So you would assume there'll be roughly about 30 billion in passive flows. But of course, this is only part of the story. This is not the only index that is likely to include India. With a long enough time horizon, other bond indices like maybe the Bloomberg Barclays Global Aggregate Index could include India as well. So it's going to be a multi-year process of more and more indices featuring India and investors building positions. The good thing is that this is a huge bond market. It's one of the reasons it's so attractive for a wide range of investors. $1.5 trillion government bond market, which means that even if you got $100 billion of foreign money coming into the market, it's not really going to distort valuations and volatility too excessively. So those favorable risk characteristics will still be maintained. And the domestic investors, the banks that you see onshore, the insurance companies, these are still going to be the most important drivers of the market. Now, in terms of the outlook, it is such a favorable environment. As you mentioned, inflation is coming down. The start of the monsoon looks more favorable than we've seen, obviously, last year. Rainfall should improve. That would help bring food prices down. The fiscal performance of the government, you have to give them an A star for that. We've really seen the benefit of fiscal reforms coming through in terms of improved revenue performance. Obviously, the outcome for the fiscal deficit has been even better than expected. And we've got the budget in July, where there is even a potential that we'll see the government set an even lower budget deficit target than was expected. Also supported by the fact that the Reserve Central Bank, the RBI is transferring a greater amount of money to the government, which has given them an even stronger position to come from. So all these things put together, you've got a very favorable supply position for the bond market and obviously increased demand for it. So we should see yields come down. Maybe as we look into the start of next year, when there'll probably be a more conducive environment, Reserve Bank of India will be able to cut policy interest rates as well. And the good thing about the bond market is, unlike other bond markets, that isn't really priced in. So in many other bond markets, we see yields already below the policy rate. In India, yields are above the policy rate. So as the policy rate comes down, we can see bond yields come down as well. So as well as the very attractive yields that you get, there's opportunities for capital gains from the bonds as well, on top of a very stable currency.
You're right. In fact, that's what we've been waiting on. At least local investors have been waiting to generate that alpha that hasn't been seen on Indian paper. But very quickly, Kenneth, you talk to clients, I'm assuming, and you know this best. Indian debt allocation would be part of the India basket in that sense. So is the Indian debt market going to compete with Indian equities in terms of flows it draws? Or is it going to be Indian debt versus other emerging market debt in that sense? Do clients have a geography allocation or an asset allocation in that sense? I don't know if I managed to frame that question right, but I hope you get the drift.
There's quite a diverse set of investors. We see everything. There are those investors that invest into diversified Asian strategies, of which India plays a large part of that. One thing I would say is, for some of the key indices that we use for Asian markets, honestly, India is still underrepresented there. The weight of India should even be higher in those indices as well. So there's the potential for Asian investors to increase their allocation to the Indian bond market. At the moment, the main focus will be on the emerging market investor group, because those are the groups of investors that are more obviously going to see India playing a larger role. And there will be reallocations within those portfolios. So they will have to sell down some of the other markets in their portfolios, some of the Latin American countries, for example, whose weights will be going down in the GBI-EM index. Those markets could get sold down in order to make space for India allocations. And but India bonds is becoming more on the radar for global bond investors. As I mentioned previously, there will be a point where India starts going into global bond indices as well. And so we'll see an even broader set of global bond investors. Now, the thing is, some of them haven't waited for India to become part of their bond indices. Some of them already understand the attractive characteristics of the market. And we've seen far more global investors investing into the India market than we did previously.
Yeah, and which is why I think we've seen this close to $10.5, $11 billion of flows since September as well. Great. Kenneth, would love to talk more, but out of time on this. But thank you so much for giving us your insights. Really appreciate your time.
Thank you.
Look forward to having you more often.
Sure. Thanks. Take care.